Listen up, folks. The financial world is buzzing with one question. Are we in a correction or a bear market? The market's been a wild ride lately, with dramatic ups and downs that have left even seasoned investors feeling queasy. The S&P 500 is down nearly 20% from its February high, a significant drop that has everyone on edge. We're teetering on the edge of a bear market and investors are understandably nervous. The fear of losing hard-earned money is palpable. Is this a blip on the radar or the start of a prolonged downturn? That's the million-dollar question. The truth is, nobody knows for sure. Predictions are just educated guesses and the market has a way of surprising us all, but we've been here before. History has shown us that the market is resilient, even in the face of adversity. Remember 2018, 2020, and 2022? Each of those years saw sharp, sudden drops. And guess what? The market bounced back every time, often stronger than before. The market's ability to recover is a testament to its underlying strength and the resilience of the economy. This time feels different though. There's a unique set of challenges that we haven't faced all at once before. We've got inflation still rearing its ugly head, interest rates climbing, and the ongoing trade war with China isn't helping. These factors create a lot of uncertainty, and that's what the market hates most. Uncertainty breeds fear and hesitation. There's a lot of uncertainty out there, and that's what the market hates most. When investors are unsure, they tend to pull back. So buckle up because we're in for a bumpy ride. The market's volatility is like a roller coaster, full of twists and turns. But don't panic just yet. It's crucial to stay calm and not make hasty decisions based on fear. Let's take a deep dive into the numbers, separate fear from facts, and see if we can find some opportunities amidst the chaos. In every downturn, there are opportunities for those who are prepared and informed. Let's navigate this together and find those hidden gems. History offers hope. The market may feel like it's falling apart, but let's take a breath and remember, market corrections are normal. They happen, and they always have. Remember the dot-com bubble burst in the early 2000s or the 2008 financial crisis? Brutal times, but the market recovered. This time the speed and severity of the decline are certainly concerning, but look closer, and you'll see this isn't uncharted territory. We've experienced similar drawdowns in recent years, and each time the market has bounced back. Remember, history doesn't repeat, but it often rhymes. While past performance is not indicative of future results, understanding historical trends can help us stay calm and make rational decisions. So, before you hit the panic button, remember, this too shall pass. While the US market grapples with uncertainty, something interesting is happening overseas. International stocks, often overlooked by US investors, are starting to shine. This shift in market leadership is a significant development. For years, the US market, particularly the Magnificent Seven tech giants, has dominated. But with rising interest rates and a strong dollar, investors are starting to look for opportunities elsewhere. Emerging markets in particular are attracting attention. With strong economic growth and favorable valuations, they offer the potential for higher returns. Now, I'm not saying to dump all your US stocks and go all in on emerging markets, but diversifying your portfolio with international exposure could be a smart move in the current environment. Okay, so the market's down, but are we talking a garden variety correction or a full-blown bear market? Let's look at some key indicators. First up, the percentage of stocks trading above their 200-day moving average. This technical indicator gives us a sense of overall market health. Right now it's not pretty, but it's not catastrophic either. We're not seeing the extreme readings that typically accompany major market bottoms. Next, let's peek at the CBOE Volatility Index, or VIX, often called the market's fear gauge. While elevated, it's not at panic levels seen during previous crises. This suggests that while investors are nervous, they're not ready to jump ship just yet. Bottom line, the market is signaling caution, not capitulation. We're in correction territory, but the worst may be behind us. Section 5, Recession Fears, Fact or Fiction, the R word. It's on everyone's mind and, well, for a good reason. When the market tumbles, recession fears inevitably follow. But how worried should we be? The truth is, recessions are a natural part of the economic cycle. They happen, and they will happen again. The question is not if, but when and how severe it will be. Right now, the market is pricing in a potential recession. But remember, the market is forward-looking, and it's often wrong. While economic growth is slowing, we're not seeing the red flags that typically precede a deep recession. Unemployment remains low, consumer spending is holding up, and corporate balance sheets are relatively strong. These factors suggest that while a recession is possible, it's not a foregone conclusion. Section 6, Earnings and Bonds Clues from the Sidelines. Let's move beyond the stock market for a moment and see what other asset classes are telling us. First up, earnings. Earnings reports provide a crucial insight into the health of companies and, by extension, the economy. They reveal how well companies are performing in terms of revenue, profit margins, and overall financial health. Corporate profits are the lifeblood of the stock market, and right now, the picture is mixed. Some sectors are thriving while others are struggling to keep up. This disparity can be attributed to various factors including consumer demand, supply chain issues, and global economic conditions. While earnings growth is expected to slow, it's still positive. This indicates that companies are finding ways to adapt and maintain profitability despite the challenges they face. It's a testament to their resilience and strategic planning. This suggests that companies are managing the current environment relatively well. They are cutting costs, innovating, and finding new revenue streams to stay afloat. This adaptability is crucial for long-term success. Next, let's look at the bond market, often seen as a leading indicator for the economy. Bonds can tell us a lot about investor sentiment and economic expectations. When bond yields rise, it often signals concerns about inflation and interest rates. Bond yields have been rising, reflecting concerns about inflation and interest rates. Higher yields mean that investors are demanding more return for the perceived risk of lending money. However, credit spreads, a measure of risk in corporate debt, remain relatively contained. This means that while there is some concern, it hasn't reached a level that suggests widespread panic or fear of defaults. This tells us that while investors are demanding higher returns for lending money, they're not overly concerned about a wave of corporate defaults. It indicates a cautious optimism in the market. This is a positive sign, and suggests that the economy is not on the brink of collapse. Instead, it shows a balanced view where risks are acknowledged, but the overall outlook remains stable. Investors and companies alike are navigating these waters with a mix of caution and confidence. Section 7, the dollar's strange behavior, a warning sign. Here's something strange happening. The US dollar, usually a safe haven during times of market stress, has been weakening. This is unusual and potentially concerning. Typically, when investors get scared, they flock to the dollar, boosting its value. This time it's different. The dollar's weakness suggests that investors are losing confidence in the US economy and its ability to navigate the current challenges. This is a development worth watching closely. If the dollar continues to weaken, it could signal further trouble ahead for the US market. It could also make international investments even more attractive, as a weaker dollar makes US assets more expensive for foreign buyers. Section 8, Q1 2025 Recap, From Volatility to Value. The first quarter of 2025 was a wild one, marked by extreme volatility and a shift in market leadership. Growth stocks, the darlings of the bull market, took a beating, while value stocks, often overlooked, showed resilience. This rotation from growth to value is a significant development. It suggests that investors are becoming more risk-averse and are seeking out companies with strong fundamentals, consistent earnings, and attractive valuations. Sectors like energy, materials, and healthcare outperformed in Q1, benefiting from rising commodity prices and increased demand. Technology and consumer discretionary stocks, on the other hand, struggled as investors rotated into more defensive sectors. Section 9, Looking Ahead, Opportunities in Q2 and Beyond. So where do we go from here? The second quarter presents a unique set of challenges and opportunities for investors. What opportunities lie ahead in the second quarter and beyond? First, don't panic. Market fluctuations are normal and can often present buying opportunities. The market may be volatile, but it's important to stay calm and stick to your long-term investment plan. Emotional decisions can lead to costly mistakes. Second, consider rebalancing your portfolio. Regularly reviewing and adjusting your investments can help you stay on track with your financial goals. If you're overweight growth stocks, now might be a good time to trim your exposure and add to value stocks or international equities. Diversification is key to managing risk. Third, keep an eye on the emerging trends shaping the future. Staying informed about technological advancements and market shifts can give you a competitive edge. Technology will continue to disrupt industries, creating new opportunities for growth and innovation. Renewable energy is gaining momentum, driven by global efforts to combat climate change and transition to sustainable energy sources. The healthcare sector is also poised for growth as the population ages and demand for medical services and innovations increases. Finally, remember that investing is a marathon, not a sprint. Stay informed, be patient, and maintain a long-term perspective. Don't be afraid to seek professional advice. Financial advisors can provide valuable insights and help you navigate complex market conditions. The market may be uncertain, but by staying focused and disciplined, you can navigate the volatility and come out ahead. Embrace the opportunities that lie ahead and make informed decisions to achieve your financial goals.